Every crash since 2008, he called it. He knew. He saw the storm before the first drop of rain fell. He worked at night, a solitary figure in a small room, the city lights a distant, blurry constellation. His world was the glow of a single laptop screen, numbers scrolling like a silent coded language. Beside him, a stack of old newspapers, yellowed headlines, a library of past mistakes. The air smelled of old paper and stale coffee. He watched the numbers move as tremors of a fragile system, a structure built on a fault line. He knew it was only a matter of time. He warned them. Not loud declarations, quiet, almost apologetic. Short, cryptic emails from an anonymous address. Single-page memos on empty risk desks, delivered by unseen hands in the dead of night. The breaking point arrived not as a single snap, but as a great, groaning collapse. In the autumn of 2008, the headlines screamed in bold black ink. Bear Stearns, Lehman Brothers, AIG. The market, once a river of green, became a waterfall of red. On television screens you saw the faces of traders, a mixture of shock and disbelief, hands clutching their heads as a lifetime of certainty evaporated in a few frantic hours. Outside the grand temples of finance, rain fell on empty streets, washing away the confetti of a party that had ended abruptly. The system had broken, just as he said it would. He watched it all from his small, dark room. He felt no satisfaction, no vindication in being right. 2 years passed. The memory of 2008 began to fade into a cautionary tale told to junior analysts. The markets were climbing again, faster and more fiercely than before. The recovery was hailed as a triumph of resilience. But the man in the quiet room was watching something else. He was watching the speed. Trades were now being executed in microseconds by powerful algorithms, machines talking to machines in a language no human could follow in real time. He saw a new kind of fragility entering the system, a fragility born not of bad debt, but of pure, unadulterated velocity. The market's plumbing was old, but the water was now being forced through it at the speed of light. His warnings shifted. His new notes were about the machines. He wrote about thin markets, where a handful of high-frequency trading firms dominated the flow of orders. The years ticked by. The bull market raged on, becoming one of the longest in history. Complacency was the new normal. But in the shadows, the old monster was stirring. Debt. It had found new places to hide, new costumes to wear. The man in the dark room, ever vigilant, was tracking its movements. He wasn't looking at mortgages this time. He was looking at corporate debt, at sovereign bonds in Europe, at strange new financial products designed to slice and dice risk until it seemed to disappear. He knew it never disappeared. It just moved to a place where no one was looking. He made it his job to look. In 2015, a tremor ran through the markets originating from China. Concerns about a slowing economy and a surprise currency devaluation sent shockwaves across the globe. Then came 2020. The catalyst was not financial, not a bank, not a hedge fund. It was biological. A virus, a microscopic thing from the other side of the world, began its silent, inexorable spread. At first, the markets ignored it. It was a distant problem, a regional health issue. But the man in the room watched its exponential growth and knew. He knew that the global economy was a network as interconnected as the flight paths that were now carrying the virus across continents. A shock to the real world, he had long warned, was the greatest threat to the financial one. A global pandemic was the ultimate shock. He sent a final, simple warning in early February. It didn't mention stocks stocks or bonds. It mentioned supply chains, consumer confidence, lockdown. He wrote that the financial system, with its record levels of corporate debt, how did he do it? How did one man, working alone in a dark room, see what entire armies of PhDs and Wall Street analysts missed time and time again? It wasn't a crystal ball or a secret algorithm. There was no magic involved. His method was painstakingly simple, almost primitive in its approach. He did the one thing that modern finance, in its rush for profit and complexity, had forgotten how to do. He read the footnotes. He looked for what was hidden in plain sight. He paid attention to the things everyone else considered boring. He read the dusty annual reports that others skimmed. He focused on the fine print. He read the legal disclosures. He read the sections labelled risk factors that lawyers wrote and executives ignored. He read the footnotes of financial statements where companies bury their inconvenient truths. He made notes of phrases like off-balance sheet entities, special purpose vehicles, level 3 assets. These were the dark closets where skeletons were kept. He never wanted to be a prophet. He simply wanted to be heard. Being right brought him no joy, only the heavy burden of knowing what was coming and being powerless to stop it. A failure to communicate. A failure to persuade. A failure to convince the people in charge to act before it was too late. He sent his memos not to say, "I told you so," but to beg, "Please, look." They saw him as an outsider, someone who didn't grasp the sophistication of their tools. The scene is the small room. The time is now, 2026, March 10th. Rain streaks down the window pane, smearing the city lights into abstract dashes of red, white and blue. A man sits before his laptop. The screen is a river of green numbers. The markets are calm, hitting new highs. He has been watching a new pattern emerge, a new debt accumulating in a new obscure corner of the system. He has just finished typing a new memo. It is short. It is clear. It is another warning. He looks out the window at the sleeping city. He was right, and no one believed him.